Hi there, my name is Jamie. Welcome to the second episode of our Quick Market Talk with Experts series. For today's session, we have renowned financial columnist, author, and inventor of the Guppy Multiple Moving Averages with us. So grab a cup of coffee and listen in to our chat on the US market. Hi Daryl, thanks for joining us today. The current macroeconomic situation appears to be more and more challenging following the news of the banking fallout on the back of rising interest rates. Can you help us make sense of the current situation and where you reckon the US indices will trade to on the back of this?
Apart from the continued rise in interest rates, there are two important factors that we need to consider. And the first is that four-letter word. We cannot understand US market activity unless we consider debt. US debt is equal to the combined debt of China, Japan, Germany, and England. And that suggests that we are likely to see a continued rise in interest rates, at least for the next quarter. Free money is becoming less free, more costly, and that has an inevitable impact on the viability of companies. And the first way that impact is felt is in the banking sector. So here's the key question. Is the current situation a result of policy or of product? The 2008 global financial crisis was a result of product. Banks were over-leveraged to CDOs, collateralized debt obligations. Once the instrument collapsed, then the banking sector collapsed, taking first the economy and then the world economy with it. In the current situation, what we have is a policy environment, partly driven by the fact that bank asset reserves under President Trump were reduced from 10% to 0%. Combine that with a good old-fashioned run on a bank and you get a liquidity crisis that can only be solved by policy direction. The Fed has indicated that they are going to continue with the existing policy direction. That's essentially what the most recent interest rates rise by 25 basis points tells us. There is no change in policy. With that in mind, with that macroeconomic situation in the background, we can make a more informed analysis of the charts of the Dow, the S&P, and the Nasdaq. And what's particular importance is to identify whether there is any divergence taking place in those market behaviors. We start with the Dow. We use a weekly chart because a weekly chart is most appropriate for identifying longer-term quarterly market outlooks. There are a couple of important features. The first is the head and shoulder pattern, shown here as A, B, and C. These are generally fairly reliable reversal patterns. And in using the pattern, we measure the depth of the pattern and project it down to set a potential target for where the market is likely to pause. We found that the Dow achieved this target, and that target identified with previous support and resistance levels. The market has since been defined, the recovery, by this downtrend line. The breakout that took place above the downtrend line created an equilateral triangle pattern. This is a pattern of indecision. That means that there is about a 50% chance that it could break on the upside and about a 50% chance it could break on the downside. It's broken on the downside. Where are we likely to see market pauses? What we know is that this downtrend line is most likely to act now as a support level. And that's an interesting chart pattern. Think of it like a playground slide. The market is likely to hit that trend line and then continue to move down that trend line using it as a support feature until it reaches a long-term historical support feature. And here is the long-term historical support feature. So what we're looking for in the next quarter, potentially, is a continuation of bearish pressure until support is successfully tested, and that then followed by a rebound. So in the short term, we're bearish. We're waiting for confirmation that support can hold at previous levels. If it does, then we're prepared to go long on the Dow.
Now, Daryl, could you just pause for me so that I can quickly jump in here to show investors how they can use a put warrant over the Dow Jones to trade a potential short-term weakness in the Dow that may slide towards the support level that you mentioned, around the 29,500 level. Now, there are two kinds of warrants in the market, a call warrant and a put warrant. A call warrant tracks the move in the underlying that it follows and is used by investors who see the underlying moving higher in the short term. A put warrant, on the other hand, moves in the opposite directions with the underlying and is therefore for someone who is bearish on the underlying and thinks it will fall in the short term. To select a put warrant over the Dow, here's how you can choose one. First, go to our website, warrants.com.sg, scroll down to the warrant search function, select the underlying of Dow Jones, decide if you're bullish or bearish. In this case, if you're bearish, you'll choose a put. When you hit on the submit button, you'll be taken to the warrant search function where you see that there are two available put warrants over the Dow Jones. To decide which between the two you would like to select, you can use the warrant selector tool to help you in deciding. Here, you will once again choose the underlying of choice. In this case, you're interested in a put warrant. And then you have to input the target level that you expect the Dow Jones to trade to and support at. 29,500, for example, which is 9.4% below where the current market is, will give you a return on the put warrant depending on the number of weeks you hold. In this case, click on the up button to increase the number of weeks you will hold the warrant for. Now you'll find that an increase in the number of weeks will lead to a drop in the percentage gain of the warrant. If you were to hold this for 1 week, the warrant will go up by 90.7%. However, if you held it for 5 weeks, you will achieve a lower percentage return in this warrant for 85.4% and 63.5% for this warrant, MSKW. If you were to increase it further, you will find that the percentage gains will keep dropping because of time value erosion or time decay, which is the holding cost of the warrant and which increases as time passes. At the 9th week mark, you'll find that this put warrant MSKW will in fact generate a negative return on the warrant despite the Dow falling 9.4% from here to your target level. This means for this warrant MSKW, if you should choose to buy it, your maximum holding period would only be for 8 weeks, where it will still generate a positive return if the Dow were to fall 9.4%. And with that, I would just like to ask Daryl, what is the difference between the Dow Jones and the S&P 500? Will the S&P 500 replicate the moves seen in the Dow?
Although we use the Dow for everyday headline media events, in reality, it's just a handful of stocks. It doesn't adequately represent the entire market. The S&P 500 is a better index for understanding what is happening within that market behavior. So the key point is, does the S&P replicate what we see on the Dow? We don't see the same equilateral triangle pattern that we saw on the Dow. There's been no strong breakout from this downtrend line on the S&P. But the S&P, like the Dow, is using this downtrend line as a new support feature, and it takes it inevitably, if you continue down with the downtrend line, to intersect the longer-term horizontal support and resistance level. Again, on the S&P, we saw a head and shoulder pattern. When that is measured, that measurement gives this downside level here. So we're looking for a continuation of the move on the downside and a retest of support. The conclusions that we reached on the Dow also apply to the S&P.
Thanks, Sarah, for sharing on S&P 500. Now, if you were of the view that the S&P 500 was on a short-term downward trend towards the 3,500 level, you could once again consider using a put warrant to hedge the downside, or simply to gain from the market falling to 3,500. Here's how you can choose the S&P put warrant on our website. To help you quickly select a warrant to trade over the S&P, you can once again use the warrant selector tool. Select your underlying, choose between a call and put warrant. In this case, if you're bearish, you'll pick put. Scroll down and input the short-term target level where you think the S&P futures will be supported at. In this case, 3,500 is 12.8% lower from here. Increase the number of weeks to see how the warrant will perform between the two and make your selection. Another way you can estimate the maximum holding period of the warrant is via the warrant calculator tool. To get there, you can click into the warrant quote here, scroll down to the warrant calculator tool, put in the underlying target price, and then maneuver the date calendar to a future date. In this case, if we were to go to 8th of June, you'll find that the warrant bid price will be unchanged from when you bought it. This despite the underlying falling by 13% to 3,500. This means for this warrant, the maximum date you can hold onto it till is 8th of June. Finally, we do have warrants over another US index, the Nasdaq 100. The Nasdaq 100 has moved quite differently from the Dow and S&P so far, rising 16.7% year-to-date as of 24th of March, compared to the Dow's 2.7% fall and the S&P's small 3.4% year-to-date gain. Consequently, we have seen the Nasdaq trending call warrant rise during this period. To find out how it's performed during this period, you can search for the Nasdaq warrants via the warrant search function. The fire logo refers to the trending warrant over the underlying. In this case, it means the warrant with the highest liquidity and tightest spread. Z2PW is the trending call warrant over the Nasdaq 100, and we can look at how it's performed historically by clicking into its historical performance tab. We'll then go backwards to 30th of December, the last day of 2022, and observe that its year-to-date performance is 77.4% given the 16.9% rise in the Nasdaq year-to-date. Daryl, how do you see this current divergence between the Nasdaq 100 and the other two US indices playing out in the near term?
So does the Nasdaq reflect what's happening in the S&P? Can we use the same strategic approaches going forward in the next quarter? Broadly speaking, they're similar charts. Again, we have the head and shoulder pattern. We have the calculation that sets at a minor historical support resistance level. This is very confused on this side, but it established itself as a fairly strong support level. But the Nasdaq is more advanced than the pattern development on the S&P or the Dow. That is, we've tested the support, had a rally, tested support, had a rally, tested support, broken above that downtrend line, haven't established the same pattern that we saw on the Dow, but the action on the Nasdaq is closer to the historical support level and the intersection of the downtrend line. That means that investors and traders can use the behavior of the Nasdaq as a leading indicator and guide as to how the price activity or the index activity may develop on the Nasdaq, on the S&P and the Dow. So what we're looking for a retreat, a general bearish environment, and a test of these two support features, the downtrend line and the horizontal historical support level. A rebound from the Nasdaq suggests that we will see a bullish rebound in both the Dow and the S&P. The Guppy multiple moving average applied to the NASDAQ shows us that there is weakening downtrend pressure. The long-term group of moving averages is beginning to compress slightly. So let's summarize. We're expecting a continuation of bearish pressure in the early part of the next quarter, but then followed by a rebound rally. The leading index is the behavior on the NASDAQ. It's not a big lead, but it's enough to give us a clue as to how the Dow and the S&P are likely to develop. So how do we trade? How do we position ourselves in this environment? As always, it's your choice. We need to filter our individual selections against the strategic background. We can work in conjunction with the index, or we can fade the index. Working with the index means that if we believe it's bearish, we continue to trade on the short side. If we want to fade the index, we look as the index moves towards its support and resistance levels, and then we take the opposite position. In other words, we go long in anticipation of support being effective in the indexes. But it's your choice as to how you approach these markets.
Indeed, it's your choice. And warrants are here to offer you the opportunity to participate in the market moves with either or both choices. Whether your choice is to short the index via a put warrant and exit when the index is at the near-term support, or go long on the index via a S&P or NASDAQ or Dow call warrant once it's hit the near-term support levels that Daryl sees, it is entirely up to you. Just remember to use the warrant selector tool as well as the warrant calculator for an indication of how the warrant will perform given your target levels on the indices, and know the maximum holding period you should hold on to the warrants. Thank you for your time today.